In just 2 days in March 2023, depositors pulled $42 billion out of a single American bank, and it collapsed before most people even realized what was happening. This wasn't 1929. This was Silicon Valley in 2023. Right now, while you're watching this, the same mechanism that destroyed that bank is still operating on top of your money. If you think what happened to Silicon Valley Bank was just some weird tech startup accident, this video is going to show you why it was just the latest chapter in a pattern that started almost a century ago. And more important, what that pattern means for your savings today, not for some Wall Street trader. The pattern is the same, only the names change. In this video, I'm going to show you 3 things. First, the exact type of number that tends to flash red before the worst banking collapses. Second, why the speed of a bank run today is dozens of times faster than it was in 1930. And third, at the end, a simple 3-question filter you can use on your own bank to decide if you stay or quietly move before everyone else wakes up. A few minutes from now, you'll understand how a single day of panic can erase decades of safe savings. Let me leave one question open for you. Between 1930 and 1933, more than 9 0 banks failed across the United States, and depositors lost over $3 billion, close to 20% of all deposits at the time, with no government insurance making them whole. By April 1933, around $7 billion in deposits were frozen in failed or closed banks. If that could happen in a slow, paper-based world, what actually stops a version of this from happening in a different form into your bank in a world of instant apps and social media? Now, let's go back for a moment. During the Great Depression between 1930 and 1933, more than 9 0 banks failed in the US. Depositors lost over $3 billion. That's roughly 20% of all deposits back then, and about $28 billion in today's money wiped out. At that time, deposit insurance did not exist, so when a bank failed, people were simply left with nothing. The life savings of millions of Americans disappeared in a few brutal years. The images you've seen, lines wrapping around city blocks, people crying on sidewalks, were the visible part of a simple mechanical failure. The bank did not have the cash that people thought existed. That wasn't the last warning. Fast forward to March 2008. Bear Stearns, one of the oldest names on Wall Street, had built itself on heavy leverage, roughly $30 to $35 of borrowed money for every $1 of real capital. A small drop in the value of its mortgage-related assets was enough to destroy its capital base. On March 14, 2008, the Federal Reserve Bank of New York had to arrange emergency funding through JP Morgan to keep Bear Stearns alive. And by March 16th, the firm was sold to JP Morgan at a fire sale price to avoid outright bankruptcy. This isn't ancient history. It's the operating system of modern banking. Here's what almost no one connects. The same basic engine sits underneath your checking account. Most people make 3 invisible mistakes. First, they believe their bank is a vault, not a leveraged risk machine. Second, they trust the marble lobby and the app design more than they trust basic balance sheet math. Third, they assume that if something goes wrong, the government will cover it without ever asking how much, how fast, and in what kind of crisis scenario. Think about a regular person. No hedge funds, no inside information, just a paycheck, a savings account, maybe a 401k. You've probably felt this already. That quiet comfort when you open your banking app, see a positive number and tell yourself, I'm fine, my money is safe. That feeling is exactly what the system needs you to have. Right up until the day too many people stop feeling it at the same time. But there's a detail almost nobody tells you. You're not really a customer of the bank. You are the fuel for the bank's risk. And in every crisis, the people who show up last at the door are exactly the ones who provided that fuel in the first place. Look at the dominoes with real numbers. From 1930 to 1933, more than 9 0 banks failed, and depositors lost about $3 billion, nearly 20% of total deposits at the time. By April 1933, around $7 billion in deposits were frozen in failed or unlicensed banks. In 2008, Bear Stearns was running with leverage close to 35 to 1. For every $1 of capital, it had about $35 in borrowed money at risk in complex securities. That meant a loss of just a few percent on its assets was enough to cripple the firm. Then, in 2023, Silicon Valley Bank announced on March 8th that it had sold over $21 billion in securities, taking a $8 billion loss and planned to raise $25 billion in new capital to plug the hole. The next day, March 9th, depositors tried to pull about $42 billion, roughly a quarter of the bank's deposits, in a single day. By March 10th, regulators stepped in and took over the bank. This is where most people realize it too late. Later in this video, I'm going to give you one specific thing to watch for. A simple relationship on a bank's balance sheet that tends to look distorted before a collapse. This isn't a prediction model or some magic formula. It's basic math with an expiration date. If you understand this one number, you will never look at your bank balance the same way again. Now comes the uncomfortable part. Banks don't fail just because they're evil. They fail because the entire model is built on one fragile assumption. Not everyone will ask for their money back at the same time. That's fractional reserve banking. In practice, the bank keeps only a small fraction of deposits as cash or reserves and uses the rest to make loans, buy bonds, and take leveraged positions. When interest rates are low, markets are calm, and everyone feels optimistic, this looks brilliant. When the cycle turns, rates jump, asset prices fall, credit tightens, the same structure turns into a guillotine. Up to this point, you might tell yourself, okay, but that's history, that's Wall Street, that's tech bros in California. This stops being history the moment you look at your own bank account. The minute you deposit money into a bank, you are no longer just a saver. You become a creditor of a leveraged institution that survives on collective belief, and your household is tied directly to that belief staying intact. Let's use a mirror. Think about a small business owner in 1931. 15 years of work, every spare dollar parked in one local bank. One morning, he hears a rumor. The bank is in trouble. Better get your cash now. He goes to the branch and sees a line around the block, people crying, the manager pale and dodging questions. By the time he reaches the counter, he's told, "We're out of cash. The bank is closed." Between 1930 and 1933, that kind of scene played out thousands of times, with over $1.3 billion of deposits lost, and no insurance to make depositors whole. Now translate that to today. You don't have to sleep on the sidewalk to get your money. You can wipe out your entire balance with 3 taps on your phone. The people in the 1930s were destroyed by concentration, blind trust, and ignorance of the real risk. The same 3 things a lot of people are still repeating right now, just in digital form. So what stops a replay today? 2 things. How the system was redesigned, and how you position yourself inside it. Now look at today. In the Great Depression, more than 9 U.S. veteran banks failed in just a few years, and depositors lost about $1.3 billion, roughly 6% of all deposits, with no FDIC to cover them. In 2023, a single bank holding around $175 to $200 billion in assets saw $42 billion of deposits flee in one day, about a quarter of its total deposits, and it went under in less than 48 hours. In 2008, Bear Stearns ran with leverage near 35 to 1. A small drop in the value of its mortgage assets was enough to destroy it, forcing an emergency rescue by the Fed and JP Morgan. Today, many banks still hold large portfolios of long-term bonds and mortgage-backed securities. When interest rates jumped rapidly starting in 2022, the market value of those long-term securities fell sharply, creating big, unrealized losses on bank balance sheets. Back in 1930, rumors spread by word of mouth, local newspapers, and slow communication. Runs could take days or weeks to build. In 2023, one letter to investors, a few tweets, and a wave of messages in private chats were enough to trigger the largest digital bank run in over a decade, almost in real time. And here's the number you need to remember. When a bank has a large share of its assets in long-term securities, sitting on big, unrealized losses, and a high percentage of its deposits are uninsured, meaning above the FDIC limit of $250,000 per depositor per bank, that bank is built for a much faster failure than anything in the 1930s. Silicon Valley Bank is the example, a huge concentration of tech and startup deposits, many far above insurance limits, plus big, unrealized losses on long-term bonds sitting on its balance sheet. When confidence cracked, the outflow was instant. So what does this mean for you? Here's the part nobody explains. You don't need to analyze every bank on Wall Street. You need a process for your own money. The biggest mistake is treating your bank like a sacred vault. The correct way is to treat it like any other counterparty risk. You are not a passive saver. You are the risk manager of your own household. And no serious risk manager keeps all their capital in a single leveraged institution with no exit plan just because the app looks smooth. In a minute, I'll give you a 3-step checklist you can use tonight to see if you're overexposed. But first, you need to accept a hard truth. Most people don't lose money because of crises. They lose money because they ignore every warning sign before the crisis and outsource 100% of the responsibility. Here's the pattern. Step 1, a period of easy money and optimism. Low rates, fast credit, everyone relaxed. Step 2, banks stretch for yield, take more duration risk, use more leverage. Step 3, something shifts. Rates spike, markets drop, credit tightens, rumors spread. Step 4, deposits run for the exit. Step 5, the first movers get out clean. Step 6, the last ones discover that their money was already a hole in somebody else's balance sheet. The pattern is the same, only the names change. If you don't understand this pattern, you become part of it. So what do you do, practically starting now? 3 habits. First, split your liquidity. Don't treat one single checking or savings account as an absolute vault. Keep what you realistically need for 1 to 2 months of expenses in your main bank. Above that, start spreading your cash. A second solid institution, and then assets with real underlying value or structures less exposed to the liquidity of one single bank. If you're regularly above FDIC limits in one bank, $250,000 per depositor per ownership category, you are choosing concentration risk. Second, watch for vulnerability signals. Anytime you hear phrases like large unrealized losses on long-term securities, high share of uninsured deposits, or emergency capital raise, your yellow light should turn on. Remember the sequence at Silicon Valley Bank. On March 8th, they disclosed a $1.8 billion loss on the sale of $21 billion in securities and a plan to raise $25 billion in new capital. On March 9th, depositors tried to pull $42 billion. On March 10th, the bank was gone. By the time it feels real, it's already too late. Third, build financial literacy as self-defense, not as a hobby. You don't need a PhD in economics, but you cannot afford to be the last person in the chain to understand how your own money is being used. Every crisis punishes ignorance and rewards preparation. This doesn't mean a total collapse is guaranteed. It means that if you behave like people did in 1930, blind concentration, total trust, zero questions, you accept being treated like it's 1930 when the next shock hits. So here's your 3-question filter for your bank right now. 1. Am I holding more than I realistically need for 1 to 2 months in a single institution? 2. Do I know, even roughly, how exposed this bank is to long-term bonds and how much of its deposits are uninsured? 3. If I had to move a chunk of this money within 48 hours, could I do it calmly, or would I be reacting in panic with everyone else? If your honest answers are, yes, I'm concentrated, no, I have no idea, and no, I don't have a plan, then the risk is not just in the banking system, the risk is in your behavior. When the next banking panic hits, not if, when, are you going to be at the front of the line with a quiet plan and diversified accounts? Or are you going to be refreshing your app, hoping they'll fix it, while withdrawals are already locked? Both positions exist. Blind trust in the system, or active responsibility. Where do you really stand? If up to now you've treated your bank as a vault and not as a risk, this video is just your first warning shot. In the next episode, we're going to look at the other side of the story. How governments have used banking crises in the past to quietly transfer billions from regular depositors to rescued institutions, with specific dates, numbers, and mechanisms. Because in the history of money, the people who understand the mechanism survive. The ones who ignore it pay the bill. This is where most people realize it too late.